Investing in the packaged goods sector can be very hit or miss, especially at the current levels of inflation and cost pressures most businesses are currently facing. But while most businesses, including the broad market as a whole, are down 30% or so, Conagra is actually up about 20% over the last year and 84% from the lows of 2019, which is the reason why we as value investors need to analyze this business to see if this may actually be the value investing opportunity for a recession-proof business, or if it's too pricey now and should be left for pension funds. So make sure to stick around to the end of the video as we talk about all that and more on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. Today we'll be starting with a full analysis into the financials of this business, the top line, bottom line, balance sheet, cash flows, and finally we'll conclude with an evaluation using our intrinsic value calculator to see what buying points we should be looking out for with Conagra. And if you do enjoy this video, make sure to subscribe as we post on here regularly, analyzing the businesses us value investors want to see the most. So make sure to comment down below with your video suggestions. Also make sure to smash that like button if you do enjoy this video so that we know to bring more of this kind of content. But with that out of the way, let's jump into the analysis. All right, and we're starting with Conagra Brands Q2 fiscal year 2023 results. What do they have for us? Well, if we take a look here at their opening statement, they had robust top line growth, which was driven by inflation adjusted pricing and muted elasticities. We will get into the details in just a second, but they also mentioned here that they had excellent margin recovery. This has been something that has been troubling the business over the past few quarters. So again, we will touch on that in just a brief moment, but supply chains have also improved as a result. These are all good things that you'd want to see from a business that you're thinking about investing in. And then finally, when it comes to the future of this business, they're focused on strengthening the balance sheet. They do have a little bit of debt, so we will talk about that as well. But for this quarter, at least another 8% increase in the sales. Again, strong margin increase across the board, which leads to higher earnings per share. So all good things on that front, but we're going to have to dive deeper to see what's really going on behind the scenes. But when we look at this from a segment perspective, we can see here growth across the board, strong growth in their snacks and retail segment. And if they can keep this up, of course, this is really going to attract investors, especially since we are navigating a challenging period. Now, with regards to the underlying elasticities, what exactly is going on here? Well, we can see from this chart here that as prices have increased year over year, quarter over quarter, they haven't actually seen that sort of drop off in elasticities that you would expect, or in other words, demand. Now, that is good for this business, but bad for the consumer, because now the consumers are paying higher prices for the same goods, and Conagra is definitely benefiting off the backs of that. But if we're looking at this from an investing perspective, that's exactly what you'd want to see. Now, if we look at this from a financial summary perspective, we can see here they brought in about $3.3 billion in revenues for this quarter. That equates to about $933 million in gross profit. And after deducting for our expenses here to run the business, we're left with operating profit here of $563 million. Again, strong increase from this time a year ago. Now, if you're not aware, these are some of their highest ticket brands that they do own, and these are the ones that make up their different segments. So when we take a look at this chart here, which is provided by Main Street Financial Data, today's video sponsor, again, make sure to check these guys out because they're providing the financial data that us value investors really need to discern key investing opportunities. And this graph really goes to show that their grocery segment has not really changed. It's not really gone anywhere over the past few years, but we have seen a bit of growth here, especially over this last quarter with their frozen goods segments altogether, again, up in that $3 billion price range. Now, if we compare this to their competitors, we can see Conagra is definitely one of the industry leaders with relatively high sales growth and the least unit sales drop off, at least in their sector. Definitely something you want to take a note of if you are looking to invest in a business like this. You want to be investing in the businesses that are industry leaders. And then that leads us down to our balance sheet and key metrics here. Their debt figures are definitely a topic of discussion here, with $9 billion in debt and only $40 million in cash on that balance sheet, which leads us to a net leverage ratio of 3.9x. They have been able to bring this down a little bit from last year, but it's still up in that 4x ratio, which is a little too high, but this is kind of what you can expect from businesses that do hold a lot of inventory on file. So that's something you're you're going to have to take into consideration on your own. Now, with regards to their cash flow, $300 million in cash from operating the business, deduct our $188 million in capital expenditures, we're left with $109 million in free cash flow for the first 2 quarters of their 2023 fiscal year. How do they actually reward shareholders with that? Well, they're taking on debt to reward shareholders with a dividend, and also with buying back shares. Definitely not something I love either. I understand they are navigating a challenging period, and I also understand the impacts of cutting a dividend, which means they should be cutting their share buybacks, especially as the stock price has been actually increasing, whereas it's always beneficial for businesses to repurchase their shares at historical lows rather than highs, as buying back shares at highs actually has adverse effects to the stock price and shareholder returns. Altogether, when you look at this from a balance sheet overview perspective from Main Street Financial, we can see we still do have decent equity within this business, which actually has been growing over the past few years. But with that leads us to our fiscal 2023 guidance, which will help us indicate where this business is going to go when we get to our calculator. They're saying they should have about 7 to 8% sales growth by the end of the year, and that margins should stay in that 15% range. Now, when we look at a historical perspective from this stock, they have been able to produce about $1.5 billion in operating income on an average scenario. So if we plug that into our calculator, and if we require a 10% return, they do currently pay a nice dividend at north of 3%. Then if they are able to grow at that 7 to 8% price range that they expect to by the end of the year, and if we keep their price to earnings ratio constant at about 32, then this stock should be worth about $110 per share on a normal scenario. Right now, we're only trading at $40 per share. Now, of course, we have to look at this from the most optimistic perspective here. Imagine they're able to grow at 12% for the next 5 years off the backs of a rebound in the economy. Let's imagine consumer spending actually expands, although that could have adverse effects on a business like Conagra. And then if we expect that for the next 5 to 10 years after that, they can grow at about 9% on a 37 PE, the stock should be worth up to $155 per share. Now, that's over $100 from where we are right now. The stock would absolutely multiply in the most optimistic scenario. But we always have to look at the worst case scenario as value investors. And if we assume that they can only grow at 3% for the next 5 years in the worst case, where we see higher levels of inflation, they're not able to increase the prices of their goods, they have further supply chain pressures, etc. Then for the next 5 to 10 years after that, they only can grow at 1%. Yeah, on a 20 PE, the stock should only be worth about $50 per share. Now, that is on the worst case scenario, and that's still higher than where we are currently at $40 per share. And that kind of gives you an indication as to why the stock is up actually about 3% since this stock reported earnings. But take these valuations with a grain of salt, because again, they do have that leverage ratio that just exceeds that limit that we're comfortable with picking up shares for a typical stock. But I mean, for an industry leader with only a 20 billion market cap, that is actually a recession-proof business, because people are always going to need to buy food. I mean, this may actually, even despite the 84% increase in the stock price since 2019, still be, fairly valued right now for a 10% return. And actually, if we go ahead here and change our required return, it's probably fairly valued right at this current point in time for a 15% return. So take that as you will. That's the analysis for today's video. I hope you enjoyed it. Please like the video if you did. Also, make sure to check out today's video sponsor, Main Street Financial Data, in order to break down the key investing data. Also, make sure to leave your thoughts in the comment section below, along with your video recommendations. Hit that subscribe button. With that, I'll see you on the next one.